A 24-year-old scrolls through Zillow at 2:13 a.m. A small apartment in New York, 2 bedrooms. Nothing extraordinary. The price tag stops everything. Not because it's surprising, but because it feels unreal. 6 figures for a down payment alone. And in that moment, something shifts in an entire generation. Because Gen Z isn't just struggling to buy homes. They are slowly realizing the system was never designed for them to enter it the same way. Somewhere between rising interest rates, inflated housing markets, and an economy built on debt, homeownership stopped being a milestone and started feeling like a mathematical error. But this isn't just about houses. It's about how money itself changed shape and why the old formula of success no longer works in the world Gen Z inherited. The first crack started quietly, not with homes, but with lifestyle. Subscriptions everywhere. Rent instead of ownership. Streaming instead of collecting. Uber instead of cars. Everything became temporary, flexible, disposable, and without noticing. Ownership itself started to feel optional until it came to the one thing that never used to be optional: a home. In the past, homeownership was built on predictability, a stable job, a fixed mortgage rate, a clear upward income path. But Gen Z entered a different system, one where wages move slowly, but asset prices move like crypto charts. Housing didn't just rise, it decoupled from income completely. In cities like Los Angeles, New York, Miami, homes stopped being places to live. They became financial instruments, collateral for wealth, stores of value for investors, products inside global capital flows, and Gen Z became the audience watching the market from the outside. But the deeper shift wasn't economic, it was psychological. Because this generation grew up inside attention markets, where value is measured in clicks, not stability. Virality replaced security. Influence replaced consistency. And money started to behave like attention, fast, unstable, rewarding visibility over structure. So when they look at homeownership, they don't just see a house, they see risk, long-term debt, locked liquidity, a financial commitment in a world that rewards flexibility. And flexibility has become the new survival strategy. But there's something deeper happening under the surface, something most people don't talk about. Gen Z is the first generation raised during financial transparency. They watched everything. Credit card debt exposed online, side hustles broken down on YouTube, people openly discussing salaries, creators showing millions in revenue and bankruptcy in the same breath. So they learned the truth early. Money is not just income. It is structure. And most people have no structure, just movement, paycheck in, subscriptions out, rent out, impulse spending out, emergency debt in, repeat. And when you zoom out, the idea of saving for a 20% down payment starts to feel almost fictional, because the modern economy doesn't reward saving at the same speed, it inflates assets. Housing is no longer just expensive, it is financially outpacing human time. But this is where the story takes a sharper turn. Because while Gen Z is told they can't afford homes, there's another group quietly buying them, not with salaries, with systems, real estate funds, private equity, institutional investors, corporations turning single-family homes into portfolios. Homes are no longer just homes. They are yield-generating assets, cash flow machines, tax-optimized holdings. And that changes everything. Because once housing becomes an asset class, it stops behaving like a human need and starts behaving like a financial product. And financial products don't care about affordability, they care about return. But Gen Z doesn't just feel priced out, they feel psychologically disconnected, because their financial reality is built on uncertainty. Student loans with compounding interest, credit systems that reward borrowing, gig economy income that fluctuates monthly, insurance costs that rise faster than wages, and a tax system that assumes stability. In a world that no longer has it, so instead of long-term commitments, they optimize for survival liquidity, cash on hand, mobility, optionality. And this is where the misunderstanding happens. Older generations see avoidance, but Gen Z is responding to risk they can actually see. They watched 2008 through their parents. They watched layoffs go viral. They watched inflation erode savings in real time, so they adapted. They didn't reject homeownership, they redefined safety. But here's the paradox. While they avoid long-term debt, they accumulate short-term financial pressure. Rent keeps rising. Subscriptions stack silently. Credit utilization increases. Lifestyle inflation creeps in through social media, because the same platforms that show financial struggle also show luxury. Dubai penthouses, Tesla interiors, minimalist millionaires. Crypto gains turned into watches, so the mind gets split. Survival in reality, luxury in simulation. And that emotional tension creates a new kind of spending behavior. Not rational, not planned, but psychological. People don't spend based on income, they spend based on exposure. And Gen Z is the most exposed generation in history. So even as homeownership declines, consumption doesn't. It transforms from ownership dreams into experience spending, travel, tech, fashion, digital identity. And slowly, the idea of owning a home gets replaced by something else. Living anywhere, belonging everywhere. Owning nothing permanently. But the financial system still operates on old rules. Credit scores, debt-to-income ratios, mortgage approvals, tax deductions tied to ownership, equity building through property. And that creates a quiet divide. Those inside the system accumulate. Those outside it circulate. And circulation feels like freedom. Until you realize it doesn't build leverage. It builds dependency on flow. This is the core tension of Gen Z's financial reality. They are highly optimized for earning attention, but poorly structured for converting attention into assets. And housing is the clearest reflection of that gap. Because a home is not just a purchase, it is forced discipline, forced saving, forced equity. A long-term anchor in a volatile world, but anchoring feels dangerous now, because everything around them moves too fast. Jobs shift, industries collapse, algorithms change overnight. Entire income streams disappear with a platform update. So commitment feels like exposure, and exposure feels like risk. But here's the part that rarely gets said out loud. Every financial system has a trade: flexibility for ownership, liquidity for leverage, speed for stability. And Gen Z chose flexibility because the world they entered demanded it. But flexibility comes with a hidden cost: time, because rent never ends, debt compounds silently, and assets, once delayed, get exponentially harder to reach. The gap doesn't stay linear, it widens, quietly, year after year, until one day it becomes structural, not personal, not emotional, structural. And that's the moment most people don't see coming. Because it doesn't feel like failure. It feels like normal life: scrolling, paying bills, renewing subscriptions, raising rent notices, saving next year. But the financial system doesn't wait for next year. It compounds every day. And somewhere inside that compounding gap, the dream of homeownership doesn't disappear. It evolves into something more complex, something more unequal, something more systemic. And the real question is no longer, why can't Gen Z afford homes? It becomes, what kind of economy makes affordability feel like a disappearing concept? Because this isn't just a generation problem. It's a financial architecture problem built on cheap money, inflated assets, global capital flows, and a culture that monetized everything except stability. And in that world, Gen Z is not late. They are early to recognizing a different reality. A reality where ownership is no longer the default path, but one of many competing financial strategies. And maybe that's the final shift: not giving up on homes, but understanding what homes have become. Not just shelter, not just status, but entry points into a financial system that rewards structure over speed, and patience over everything the internet taught them to value. And in that contrast between scrolling life and compound life, a quiet truth emerges. In the modern economy, the biggest divide is no longer income, it's ownership of time. And homeownership is just where that divide becomes visible first.